Welcome to the Deep Dive. If you need the executive summary of the most critical investor calls, well, you're in the right place. Today, we're dissecting the Republic Services, or RSG, third quarter 2025 earnings call. That happened back on October 30th.
Yeah, and this one is, it's really a textbook example of that kind of corporate tension you sometimes see.
How so?
Well, management, they absolutely delivered. I mean, one of the strongest margin expansion stories we've seen this quarter. It really proves their structural pricing power is, robust.
Okay.
But the market just seemed to refuse to look past some softening demand signals. It was fascinating.
Boy, that's the core tension we really need to unpack for you.
Yeah.
You've got RSG delivering this massive earnings beat. Yet the stock actually slid, 0.8% right after the call?
Yeah. Investors felt spooked, definitely spooked by something management was, let's say, trying hard to minimize.
Okay, so let's find out what that was. We should probably start with the immediate data snapshot, the results.
Yeah, let's do that. And we have to acknowledge the beat first. Can't ignore that. Adjusted earnings per share, EPS, came in at $1.90.
$1.90, and consensus was?
Consensus was hanging around the $1.78 to $1.79. So this wasn't just a slight beat. It was like 6% to 7% above the street.
Wow, okay.
That's phenomenal performance. I mean, really strong on the bottom line.
But then why the market weakness? Why the slide?
Well, the top line. That was the immediate culprit, it seems. Total revenue was $4.21 billion.
Okay.
And that landed just a bit shy of consensus estimates, which were around $4.25 billion.
So a slight miss there.
Slight miss. And total year-over-year revenue growth, it slowed down to 3.3%.
Okay, 3.3%. Still growth, but maybe slower than expected.
Exactly. But the real insight here, I think, is where the money was made. Adjusted EBITDA hit $1.38 billion.
Right.
And that expanded the margin by 80 basis points year over year, hit 32.8%.
80 basis points is significant margin expansion.
Huge. It tells us that while they maybe struggled a little to bring in those brand new dollars, they proved they are masters at converting the revenue they do have into profit.
So execution.
Brilliant execution on profitability. But, that marginal volume weakness, that's what grabbed all the headlines.
Okay, let's dive into that margin story then, because like you said, it really defines the company's defensive strength, maybe.
Yeah, I think so. Management's primary theme, they kept repeating it, was pricing ahead of cost inflation.
Right. But what structural proof did they actually offer for that claim? I mean, talk is cheap.
Fair point. But the proof is really in the pricing data they shared. Core price growth was a solid 5.9% on total revenue.
5.9%.
Yeah. But if you zero in specifically on what they call related revenue, that's the contracted commercial and residential work, the core price was even stronger, 7.2%.
7.2% on the core contracted business.
Yeah.
That really speaks to the almost utility-like nature of the solid waste business, doesn't it? They can raise prices almost regardless of the macro picture.
It certainly seems that way. And when you look segment by segment, the pricing discipline is just, relentless.
Give us the breakdown.
Okay, so they showed strength pretty much across the board. Small container pricing was up 9.2%.
Wow.
Large container pricing hit 7.1%. And even the residential segment, which can be tougher sometimes, saw 6.8% price growth.
That's how you fight inflation.
That's exactly how you do it. But, pricing alone isn't quite enough to expand margins by 80 basis points. You need operational improvements, too.
Right. What else was driving it?
Well, management specifically called out labor productivity. They showed a 70 basis point improvement as a percentage of revenue.
Okay, 70 basis points from labor. How?
This brings us to a proprietary term they use, the RISE platform.
RISE, right. For listeners who might be less familiar with RSG, can you give us like the 10-second definition? Is it just fancy routing software?
It's more than that. It's really their strategic operations overhaul. Think of RISE as this integrated tech platform. Yeah. It covers dynamic route optimization, but also predictive maintenance, standardized operational workflows across the whole fleet.
So it's about efficiency gains.
Exactly. It's what allows them to get more work done with the same or maybe even fewer labor hours. That 70 basis point improvement, that's the proof that years of investing in this tech are finally paying off, seriously bearing fruit.
Okay, so if the execution on pricing and costs was, let's say, near flawless, we have to ask, was this structural pricing strength just successfully covering up something maybe deeper? Where did the market find its fear? What spooked them?
Yeah, the fear was purely in the organic volume numbers. Total organic volume actually contracted. It went down by 0.3%.
Down 0.3%. Okay, that's not huge, but it's negative.
It's negative.
Okay.
And what's fascinating here is where that contraction hit hardest. A pretty steep 3.9% decline in large container volume.
Large containers, down almost 4%. And why does that specific number matter so much?
Because it signals potential deterioration in high-value cyclical sectors. Large container volumes are typically tied to, high-margin industrial activities.
Like manufacturing, construction.
Exactly. Heavy manufacturing, non-residential construction. When that number drops nearly 4%, it kind of confirms that investor anxiety. The fear that the macro slowdown is finally hitting RSG's commercial client base.
Got it. And the epicenter of the actual revenue pain seemed to be the environmental solutions business, ES.
Oh, absolutely. That caused a staggering 140 basis point drag on total company revenue.
140 basis points just from ES.
Just from ES. It was definitely the major headwind. ES revenue actually decreased by $32 million year over year.
And ES is more specialized, right? Industrial waste events?
Correct. This segment, it deals with industrial and event-based waste streams. It got hammered by, continued softness in manufacturing activity, plus fewer emergency response jobs and just lower overall event activity compared to last year.
And given that ES assets, specialized machinery, trained staff, they have a relatively fixed cost structure.
Right. Pretty much, yeah.
So that top-line weakness must have just hammered the margins in that specific segment.
Precisely. The adjusted EBITDA margin in the ES business, it dropped sharply, down to 20.3%.
Ouch.
Yeah. And management admitted, they said they're actively retooling ES pricing. They even noted they might have previously overshot the ideal price point for certain services.
Pushing customers away in a slow market.
Kind of sounds like it. Pushing them to find alternatives. So now they're trying to find that volume again, maybe adjusting prices downwards a bit.
Okay. We also can't ignore the drag from, external commodity forces. What was the impact of recycling? The commodity beta?
Yeah, that was a serious headwind, too. Recycling commodity prices averaged $126 per ton in Q3.
$126. And compared to last year?
That is a substantial $51 per ton decrease year over year.
$51 lower per ton. Wow.
Yeah, that decrease alone was responsible for a 20 basis point decrease to the overall company margin.
Just from lower recycling prices?
Mm-hmm. And here's the kind of concerning fact. Current prices right now are running even lower, near $120 per ton.
So that headwind continues?
Yeah.
Okay, so they are battling cyclical price drops in recycling, cyclical volume drops, particularly in large containers in ES.
Right.
But they still expanded overall margins by 80 basis points? I mean, that sounds almost too good to be true. Was any of that margin expansion maybe tainted by non-repeating factors, one-offs?
I'm glad you asked that because, yes, there was a factor. Landfill construction and demolition volume, C&D volume, increased by a whopping 45%.
45%? Why?
It was driven by $35 million in hurricane recovery efforts down in the Carolinas.
Hurricane cleanup. That's typically high-margin stuff.
Very high margin. This event-based activity contributed 40 basis points to the quarter's margin expansion.
So half of the 80 basis point expansion came from hurricane debris.
Essentially, yes. And year to date, that non-repeating, high-margin, event-driven revenue totals $100 million.
Okay. That $100 million feels like the most crucial number for our discussion about 2026, because that's not coming back next year.
It is absolutely crucial. But before we get too far into the future headwind, let's look at their proactive defense. Management isn't just sitting there. They're clearly balancing these short-term cyclical challenges by deploying massive amounts of capital for the long term.
Right. The spending. They're spending big to compound EPS, even when organic volume slows down.
Exactly. RSG invested $1.01 billion in strategic acquisitions just year to date.
$1 billion on M&A.
Aimed at deepening market density, adding capabilities. Meanwhile, they also returned $1.13 billion to shareholders through buybacks and dividends.
So more return to shareholders than spent on acquisitions. But does that massive capital deployment, spending $1 billion on M&A, does that prove they're basically buying growth because they can't quite earn it organically right now?
I mean, it certainly confirms their priorities. They're using their formidable free cash flow to acquire stable contracted routes and return capital. It ensures EPS growth stays somewhat insulated from the soft macro environment. It's a playbook, really, designed specifically for periods of volume weakness like this.
What about the big environmental transition stuff? Those long-term projects, RNG, plastics recycling, are they starting to contribute meaningfully yet? Acting as a reliable future growth engine?
Incrementally, yes. They brought one renewable natural gas RNG project online in Q3. That brings the year-to-date total to 6.
Okay.
They expect 7 for the full year 2025. They also commenced commercial production at the Indianapolis Polymer Center. That's their big plastics recycling initiative.
Right, the Polymer Center.
Which is co-located with a Blue Polymers facility that's expected to start production late in Q4. So these are foundational assets, yes, and they should deliver high incremental margins down the road.
And electrification. Are they still marching forward there, preparing for future fleet costs?
Seems so. They have 137 electric collection vehicles in operation now. They're aiming for over 150 by year-end 2025.
Okay.
And that's supported by 32 facilities that now have commercial-scale EV charging infrastructure. It all speaks to, long-term planning. Thinking ahead.
Okay, let's pivot then to guidance and the path forward. Because the market is clearly hyper-focused on how they clear the hurdle for 2026. What did management actually say about the outlook?
Well, for the full year 2025, management nudged revenue guidance toward the low end of the prior range.
Okay, acknowledging the pressure.
Exactly, confirming the macro pressures we've been talking about. But they reiterated confidence in hitting all the other financial components, leaning really heavily on that pricing power we discussed earlier.
Right. Now for the brutal math problem. That $100 million in event-driven landfill revenue from this year, 2025.
The hurricane money.
Yeah, the hurricane money, which came at, an 80% incremental margin?
That's what they indicated, yeah. Extremely profitable.
That will not repeat in 2026. That's a huge hole to fill. What levers did management specifically say they'll pull to clear that hurdle?
Yeah, this is the crucial headwind. It has to be factored into all your 2026 growth assumptions. Management stated that their long-term growth algorithm, their target model, remains intact.
Which is?
Mid-single-digit revenue growth with EBITDA and free cash flow growing faster than revenue.
Okay, so they think they can still hit that despite the headwind.
They believe the incremental contribution from those 7 RNG projects coming fully online, the new Polymer Center ramping up, and their continuous M&A pipeline. They think all that will help bridge the gap.
Did they offer any specific comfort on the environmental solutions business? Is that stabilizing after Q3?
They noted seeing demand stabilization exiting Q3. So they suggested they think they've kind of found the bottom there.
Okay.
And they remain confident in growing the ES business again in 2026, even under what they called a conservative macro outlook.
There's always a but.
But they cautioned that Q4 is also a tough comparison for ES because they had a major emergency response job late last year.
Another non-repeater.
Exactly. So the ES recovery, it's probably going to be slow and steady, not some sharp V-shaped rebound.
Okay. That brings us perfectly to the segment we call This Is Not Financial Advice.
My favorite part.
Where we try to synthesize all these facts into one, let's say, outrageous but plausible trade idea based on the tension in the call.
Okay, the setup seems pretty clear. RSG's stock weakness, it stems purely from these short-term cyclical volume concerns. You've got the ES softness and you've got that non-repeating $100 million revenue hole.
Right. Temporary issues, arguably.
Arguably. But the core story, the structural pricing power, that looks better than ever. They actually expect to maintain a 75 to 100 basis point spread over cost inflation even in 2026.
So the market is focusing on the temporary weakness, maybe ignoring the permanent insulation from pricing.
That's the thesis. So what's the trade?
Let's hear it.
Well, we're betting on the structural strength winning out over the cyclical fear. You could consider going long RSG equity.
Okay, buy the stock.
Betting that the market is basically overestimating the impact of losing that $100 million, 80% margin revenue in 2026.
And how do you maybe juice that or fund it?
Well, you could potentially fund this by selling some short-dated, out-of-the-money put options.
Filling puts. Why?
To capitalize on what's historically been pretty muted post-earnings volatility in the specific name. You collect some premium. The core thesis, right, is that the durable pricing mechanism in the solid waste franchise, plus the incremental contribution from those 7 RNG projects and the new Polymer Center, that combination will surprise the street by bridging that 2026 gap faster than expected.
Rewarding patient holders.
Exactly. It's a trade that capitalizes on the market's fixation on the cyclical ES weakness over the structural pricing strength.
That is definitely a strong bet on management's ability to execute against what looks like the toughest comparison they've faced in years.
Well, it capitalizes on the market focusing on, let's call it short-term chaos, instead of the long-term utility-like predictability of the core business.
Okay, so to recap for everyone listening, RSG delivered a powerful earnings beat, driven almost entirely by disciplined pricing and operational execution. It really proved the consistency of its core business model.
Right.
But the market fixed intensely on the volume miss, especially in ES, and that looming shadow of the non-repeating hurricane revenue from 2025.
Yeah. And the key takeaway for you, the learner, is really to connect capital allocation to these volume trends. When volumes decline, cash conversion and how they deploy that cash strategically become absolutely paramount.
Right.
RSG's year-to-date adjusted free cash flow is huge,
Right.
$2.19 billion.
$2.19 billion.
So the crucial question going forward, the thing you need to track, is whether the company will be able to sustain its disciplined capital allocation, that pace of M&A and buybacks at the same rate to continue that powerful EPS compounding. Or will the persistent macro-industrial softness force a pivot? Will it slow down the pace of that strategic spending? That's what you need to watch for in Q4 and into next year.
Fascinating dive. Lots to think about there.
Always is with these calls.
We'll catch you next time on The Deep Dive.